SoFi just raised full-year revenue guidance, even though the rate outlook flipped from 2 cuts to 1 or 2 hikes since they last spoke. That takes real conviction. We are doing this video in 2 parts. First, I'll grade the report, then walk you through how I'd trade it. This is SoFi Technologies, ticker SOFI, for Q2 2026. This is not financial advice. Everything in this video is just my own opinion for educational purposes only. Trading involves risk, and your results may vary. So revenue came in 8.29% ahead of estimates, and I want you to sit with that for a second. Because adjusted net revenue grew 40% year over year to a record $1.2 billion. That's their 19th straight quarter above the Rule of 40. And on EPS, they beat by 9.09%. But here's the catch. Reported EPS was 12 cents, and that got hit by about a nickel of tax drag because the tax rate came in at 22% versus the mid-teens they originally guided. Clean it up and EPS was closer to 17 cents, which tells you the operational beat was bigger than the headline looks. So on the beat itself, and I'm grading against the clean numbers, not the tax drag depressed headline. This earns a B. A solid revenue beat plus a clean EPS that would have been closer to 17 cents is a legit double beat, just not a blowout. And on consistency, this is an A. SoFi has been beating quarter after quarter, and 19 straight quarters above the Rule of 40 is exactly the track record you want to see behind a print like this. The top line here is just clean. Adjusted revenue of $1.2 billion, up 40% year over year, and adjusted EBITDA up 44% at a 30% margin. That's growth and profitability moving in the same direction. They added a record 1.1 million members in the quarter, but the number that actually matters is cross-buy. 51% of new products were opened by existing members, up from 35% a year ago. The CEO called it escape velocity, and honestly, that's the right word for it. The loan platform business, which is the piece where SoFi originates loans for other institutions and takes a fee, just structurally expanded. A $1 billion 6th Street deal for personal loans, a $3 billion base point agreement for small business loans, and first home equity transfers to a global bank. This turns the platform from a one-trick channel into a multi-asset business. Tangible book value grew 80% year over year to $9.5 billion, or $7.34 per share. That's the fundamental floor underneath the stock, and it just got a lot bigger. And then the kicker. They raised full-year revenue guidance to $4.75 to $4.85 billion. Even though the rate outlook flipped from 2 cuts to 1 or 2 hikes since they last spoke. Raising into a worse macro backdrop takes real conviction. So on profitability, I'm giving this an A-. 44% EBITDA growth at a 30% margin plus 19 straight quarters above the Rule of 40 is elite. The only thing keeping it out of straight A territory is financial services margin compression, which we'll get to in a second. First blemish. The reported 12-cent EPS took about a nickel hit from a tax rate that came in 7 percentage points higher than originally planned. Clean number would have been closer to 17 cents. It's not operational, but it's still real money. Financial services contribution margin dropped 6 percentage points year over year to 46%. Down from 52. That's because they're spending hard on new products like Coach, Plus, big business banking, and small business. Right call strategically, but it does pressure segment margins near term. The technology platform segment is the ugly part of this report. Revenue fell 23% year over year, and contribution profit collapsed 65%, mostly because a big client fully transitioned off at the end of last year. Total accounts still down 16%. That segment needs to stabilize. Here's the one that irritated analysts on the call. They raised revenue, but held EBITDA guidance flat at around $1.6 billion. When Dan Dolev pushed the CFO on why, she said flat out they're reinvesting the incremental revenue into growth instead of dropping it to the bottom line. And the loan fair value marks stepped down. Personal loans down 71 percentage points, and student loans down 85, driven by higher discount rates and modest bumps in default and prepayment assumptions. That's the direct read-through from the rate outlook flipping. So on guidance, this is an A. Raising revenue into a worse rate environment is exactly the kind of move that signals real conviction. Even with EBITDA held flat, the raise itself is the story. And on red flags, I'm at a C+. The technology platform decline and the financial services margin compression are both real, and the EBITDA guide staying flat means investors aren't getting margin expansion in the back half. Manageable, but not clean. Putting it all together, this was a clean double beat with a strategic inflection layered on top. Cross-buy going from 35 to 51% in 3 quarters, guidance raised into a worse rate environment, and tangible book value up 80%. That's thesis validating stuff. The blemishes are real but manageable. The tax drag, the technology platform drop, the flat EBITDA guide. So overall, I'm giving this print a B+. Real quick before we get into the report, if you're getting value out of these review videos, do me a favor and hit that like button and subscribe to the channel. It's completely free, it takes 1 second, and it's genuinely the biggest thing that helps this channel keep growing. Alright, let's get into it. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. This report actually strengthens my case for getting in. Cross-buy accelerating from 35% to 51% year over year, plus raised revenue guidance in a worse rate environment, tells me the everything app story is working. The weakness I'm seeing after the print is mostly implied volatility collapsing, not the fundamentals cracking. That is exactly the entry window I want to use. Management named enough forward catalysts, like SoFi Plus scaling toward 1 million subscribers, and the loan platform expanding into small business and home equity, that I have visibility for the next couple of quarters. So my plan is selling cash-secured puts at strikes 10 to 15% below the post-print price. I get paid while I wait for a better entry. The fundamental floor under my cash-secured puts just got a lot sturdier. Tangible book value is $9.5 billion, up 80% year over year, and the capital ratio sits at 18.8%. For my strike ceiling, I want a level I would genuinely be happy owning shares at given the raised outlook. Anything tighter than that is really a directional bet dressed up as premium collection. I lean toward 30 to 45-day expirations, because that is where I capture the post-earnings implied volatility crush before it fully bleeds out. My absolute worst-case anchor for a strike is below the tangible book value per share of $7.34. That is the line I build around. For my share position, this report structurally moves the story forward instead of just nudging it along. Management named enough forward catalysts that I do not feel any need to trim into strength. The loan platform pushing into small business and home equity, plus SoFi Plus adding 200,000 subscribers in a single quarter, are exactly the diversification proof points I wanted to see before the market pays a higher multiple. The return on tangible common equity framework management laid out, targeting 25 to 30%, now looks like a credible base case to me rather than an aspirational number. So I'm holding what I have and looking to add on any post-print weakness. I only trim if my position size has drifted above my target allocation. This is where my covered calls get uncomfortable. Between SoFi plus scaling, the small business and home equity ramp, and the commercial banking onboarding, my upside cap risk is elevated for the next few quarters. For any new covered call rights, I'm pushing strikes 15 to 20% out of the money and preferring 45 to 60-day expirations. The raised guidance means the stock can revalue meaningfully higher on any macro tailwind. Selling tight strikes against a print of this quality is fighting the tape, and I do not want to be that guy right now. If my strikes are near or in the money, I'm seriously looking at rolling them up and out. Letting shares get called away here means selling into a structural repricing. My LEAPS thesis just got materially stronger. The return on tangible common equity framework, targeting 25 to 30% margins, is now backed by tangible book, growing 80% year over year, and cross-buy actually inflecting. This is a 24-month story playing out, and premium decay accelerates hard inside of 12 months. I do not want to be short duration on a name where the multiple expansion is still ahead. If I have real gains sitting in these contracts, I'm holding until I see either the 1 million SoFi Plus subscriber milestone confirmed or the technology platform segment reaccelerating. For any leaps inside 12 months, I'm rolling them out to longer dated expirations so I keep the runway the thesis actually needs. If I'm underwater on a fundamental thesis here, this print validates averaging down. Cross-buy going from 35 to 51%, raised revenue guidance, and the loan platform expanding structurally are exactly the proof points I needed. For my average down price, I'm anchoring to tangible book value per share of $7.34, plus a reasonable multiple for the capital-light fee businesses. That is my fundamental floor. The one thing that would invalidate adding is the technology platform segment continuing to deteriorate. I'm watching total accounts sequentially over the next two prints for that signal. If I'm adding fresh rather than averaging down, I'm scaling in over 3 pieces rather than dumping it all in at once. Post-print drift usually gives me a better entry than day of prices. Bottom line, this print earns a B+ from me. The Everything app monetization story just got a lot more credible, and that changes how I think about the name on a 12 to 24 month arc. That's my take. See ya on the next one.